Welcome to my channel. I'm Dr. Romano. I would like to discuss with you today about hedge funds and why larger hedge funds are not really the best investment for your capital. Who am I? Well, I'm Dr. Hedgefund on YouTube, and the reason behind my channel is because I have a PhD in finance, and all of my 1,000 pages of research is about hedge fund selection and risk management. This is a great video because I'm going to share with you my research findings with the actual data that I conducted. Before we continue the video, please remember to do thumbs up, press the button, and subscribe to my channel. It's right there. It doesn't hurt, but it will really help me out. Thank you so much. The issue today is that hedge funds are copying the same thing that investment banks are doing, those large hedge funds. They're hiring traders to trade for them. And when you have 50 traders or 100 traders or even 2 or even 5, when you clump all those returns together, you get a watered down return. Okay, so that's one reason why you wouldn't want to invest in a hedge fund that has a lot of AUM. There is a magic number based on my research, and I will share that with you at the end of the video. But for now, you also have an issue that not all strategies can scale up. What happens is, when hedge funds start out and they have raised 50 million, their strategy is actually still doing good at 50 million. But sometimes when they go up to 200 million, that same particular strategy is really difficult to scale up. That strategy is harder to scale up. So it just depends what their strategy is. And by asking a hedge fund manager what their strategy is, you're not going to get the truth out of them because that's private information. They will tell you what they want you to hear. And so for this reason, you need to look at the returns only. Don't waste your time interviewing these people, whether you like them or not based on their personality, whether you look at their education, whether you look at their experience prior to the hedge fund. All of that is irrelevant. And that's based on my research as a PhD graduate. And I've written a second book, and that's what the second book is about. All of my other findings. It hasn't been published yet, and so forth. So the magic number for a hedge fund, you should not invest in any hedge funds that are more than 350 million in AUM. But there are certain hedge fund strategies that are still doing good at $1.5 billion. However, once you get past 2 billion, that becomes very probable. Again, it depends on strategy to invest in them because they're going to start to have watered down returns. And so if you're creating a portfolio of hedge funds, such as a funds of funds for yourself even, you would not want to invest in a large fund. You actually want to invest in the smaller funds because the smaller funds has nothing to do with them proving themselves. It has to do with their strategy is fresh, they're testing it out, and their position size is smaller than those billion-dollar hedge funds. And again, it's up to you to really analyze those returns once it gets past 350 million. Some hedge funds have a problem at 100 million. But that's because of their strategy, and everything depends upon who's trading and the algorithm who made it, or even the hedge fund manager, what's their threshold to mentally accept. And so when you interview a hedge fund manager and you think that, oh, because they have 20 years experience and they have $30 billion in AUM, that's a safe investment, and that they're only doing 5, 6, 7%, no, that's not a safe investment. You as an investor need to maximize your capital, and that's by selecting smaller hedge funds that are performing really well in the different type of markets. But you're not going to be able to find one or two hedge funds that are capable of making returns in every kind of market condition. And so that's why you need a portfolio of hedge funds, and you need a lot of money for that. So having $5 million and trying to create a portfolio, no, it's not going to work. And this is another reason why it's so difficult to get into the hedge fund industry and become an investor, because you have to put the $1 million or $2 million minimum, depending on which state they live in. And so this is a reason why you should be focusing, if you have 5 to 10, 20 million, let's say, or even $1 billion, you should be focusing on the funds of funds. Because the funds of funds are capable of spreading out the risk. And this is very important. And they are also capable at maximizing the return on investment. So if you have, let's say, 8 to 10 hedge funds in our funds of funds, well, that funds of funds could certainly leave you 20% average per year. In a very good economy, 30% average is actually pretty good. Whereas if you invest in 5 or 2 hedge funds, because you don't have that kind of capital, 5 million, 10 million, well, unfortunately, there's going to be a market condition that hedge fund can't trade in and make money. They may lose money. So again, but that same hedge fund may do really well in a stock market collapse. Again, to say that you're going to lose everything, well, it's because you didn't diversify your risk. I want to thank you so much for watching my video. Please remember to subscribe to my channel. Do thumbs up. It will really help me out. Thank you so much.